morning, ladies and gentlemen. The mood is a little better on Dalal Street as far as Tuesday is concerned. You have strength in the NIFTY consumer space. NIFTY itself is about 0.7% higher. 24,200 is what we are seeing, mainly on account of short covering. There's also some sort of exit being worked out in this West Asian conflict. Crude itself, which was spiking at somewhere like $120 per barrel yesterday, is now somewhere like $89 a barrel, down about 6.5%. To discuss the short-term nature of the market and what would you want to do at this point of time, we are now joined by Mr. Mayuresh Joshi. Mayuresh is working with William & O'Neill Securities and has a very, very strong grip on not only the short term but also the medium and long term markets. Good morning, Mayuresh. A very warm welcome. You must be heaving a sigh of relief with crude now down substantially from its nearest high.
Morning, Shell. Absolutely. Again, I think as every expert is probably pointing out, I think this is one major factor that's affecting not just the Indian markets but global markets at large. And therefore, any respite in terms of crude, any news flow in terms of what happens in terms of both supply of crude as well as gas, I think that will give a big relief to not just a lot of economies across the globe, but also the Indian markets.
Okay, fair point. How are you now watching this crude oil issue in the market? Is this a pain point that is likely to persist? There are views in the market that the days of $55 to $60 a barrel are now well in the past. What would be the new trading range for crude oil?
So, Shell, I think very interesting. If you probably look at the earlier conflicts that have happened and the spikes which have happened because of that, was created because of inherent pressure that got created into the system, specifically supply side pressures. Therefore, I think the base case scenario that a lot of analysts were working of 70 to 75, if this continues and elongates for longer, obviously I think crude is going to settle higher than most estimates on the street. Now, you all understand the macro impact in terms of crude and the pricing thereof, both in terms of inflation, in terms of current account deficit in the Indian context. But to a large extent, if you pull out prices of crude 1 year from now, so if you're probably looking at an April 27th forward contract, I think that is probably trading at a discount of almost $40 to $50 as we speak to the current spot prices that were yesterday. So to a certain extent, the forward prices, that is a 1 year down the line price, or even the December contract to a large extent, is penciling crude prices which is $40 to $50 lower from yesterday's high, which is almost 120, which is close to that $70, $75 a mark. And therefore, I think the forward markets are actually believing that this is not going to probably last much longer than one probably expects. However, I think beyond a few weeks, if this continues, I think the escalation over the next 2, 3, 4 weeks, this can still get embedded in terms of the full year not being at risk. But if it extends beyond that, I think there is a risk element probably coming through. So I think the base case scenario of 70, 75 is still something what the forward markets 9 months and 1 year down the line are probably suggesting as we speak. However, everything points out on how the de-escalation and resolution happen. If they do happen, I think crude can quickly revert back to 70, 75. If it doesn't, I think then the new normal, if it consolidates or continues longer, it can linger around this $85, $90.
Okay, fair point. Now comes the most difficult part, Mayuresh. Portfolios have been damaged. Sentiment is nearly beyond repair. Rupee is at a record low, and FIs are withdrawing money as if there's no tomorrow. In this kind of scenario, what do you suggest does one do? Have faith in equities or just move to fixed income?
No, again, I think equities is something that is going to compound your wealth over a longer period of time. Obviously, what has transpired, even in the earlier occasions, so whether it's been wars, the COVID crisis, so many crises before this, the 2008 financial crisis, equities have always come back stronger. And obviously, I think a base case scenario that is now getting played out. Yeah, again, I think it's all fluid as we speak at this juncture. That over the next few weeks, if there is this de-escalation, and I wouldn't say that things come back to normal immediately, but there is de-escalation and things start normalizing. I think the full year estimates in terms of how markets are placed, specifically from an earnings perspective, look very, very strong and robust. The inflationary angle, if this de-escalates, gets thrown out of the window as well. As I said, for the next few weeks, the inflation angle will not get played out. And therefore, if such a scenario probably happens, which is the best scenario from a market perspective, I think both the angles probably start working in favor. From a risk reward and a valuation perspective, I think if the market from a base index headline perspective, if it corrects another 3 to 5%, in my sense, I think valuations will become extremely attractive for the markets with the assumption of a 12 to 14% earnings growth happening over the next couple of years. And liquidity probably and growth levers probably staying into the system as well, duly supported in terms of the capex spends by the government and the regulatory actions in terms of liquidity management by the RBI, specifically in the Indian context. And therefore, from a pure headline perspective, another 3 to 5% correction in the market will make the markets extremely, extremely attractive.
Mayuresh, what we are grappling at is an issue. You buy a stock at 52-week low, hoping the margin of safety is there, the stock falls further. You buy it at maybe a 100-week low, again the stock falls to 122-week lows. The issue is that there is no follow-up buying happening. You and I are, of course, long-term players in the market, so we understand this mood of the Sensex or the Nifty at this point of time. But what about new investors, people who've stepped in the last 2-3 years? They are having a terrible time, not only in their fund portfolios but also in their stock picks.
You are absolutely right, Shelson. And therefore, I think the markets is a great learner and a teacher as well. And therefore, I think one must really understand for the last 18 months, I think the markets have been going through a whole host of issues. I think what markets genuinely follow is how earnings play out, and a complement of all that. If earnings are supportive, if global macros remain stable, and if domestic macros remain strong, the flows, both in terms of domestic investors as well as foreign institutional investors, complement that sentiment, and they come in very, very strongly. Because earnings were missing over the last 18 months, obviously I think foreign flows reverted back to their mother markets, US markets, where the entire AI theme was in full top gear as we speak. And therefore, if you probably look at how the developed markets performance has been, whether you talk about the US markets, whether you're talking about the DAX index in the German context, or even the Asian peers, the KOSPI, in fact, hit all-time highs. Now it's correcting because of the global geopolitics. I think all these factors were at play. Now, as we stand, one must really understand that the pain period in terms of Indian equity markets is largely behind. We've gone through geopolitical issues as well over the last 4 years. The Russian-Ukraine war is an example. What happened in the Middle East over the last 12 to 15 months, though this is at a far larger scale compared to what happened in the Middle East a few quarters back. And therefore, I think some resolution on the geopolitical front over the next few weeks, in the next couple of months, make us believe that earnings, which become the core factor and the tenet for the market, will hold up very, very strongly. And if the market's correct, valuations become attractive. Now, when both these factors start playing out, I think the next 12 to 18 months become extremely attractive from a market return perspective. So I completely subscribe to your point. It has been very frustrating for the last 18 months. But this is how equity markets are. You never will have 3 to 4 years of strong linear growth. You'll always have pullback periods, which have happened for the markets. And now, in my opinion, in the next few months, as we go past all these global events, geopolitics, economic wise as well, India will probably stand out to be better placed than most markets.
Although it's a theoretical exercise, Mayuresh, we are all invested more than 120% of our net worth in equities. Suppose some fresh money comes in from some jadui ka chirag, kahin se paisa aa gaya. So, where do you put it? What is William O'Neill's research saying in terms of quality stocks that are going a begging?
Oh, absolutely. So at Markets with India, I think our belief, Shelter, as you know, has always been chasing quality, chasing leadership, and probably chasing growth where price earnings and growth, the peg part stays with the industries. And therefore, to your point, in terms of buying at lows, is not something we subscribe at. Our logic is that where sectors are showing strong momentum and strong growth dynamics and levers with reasonable valuations, I think those are the sectors you need to follow. And therefore, 3-4 sectors is what we've got on our watch list. We are creating a watch list, Shelter, as we always do in tough periods like these. So when these sectors and stocks within those sectors make those bases, which are very, very attractive, they become attractive entry points for medium-term investors. So banks as an example, I think a lot has been said over the last few weeks. It had a fabulous run. But banks like State Bank of India as an example, if it pulls back and it forms a good base at lower levels, fabulous set of numbers, fabulous commentary, expectation in terms of a lot of the parameters that State Bank is probably dwelling upon, whether it's asset quality, whether it's the growth levers in terms of credit advanced deposit ratios, whether you're talking about asset quality, whether you're talking about NIMs, capital adequacy, all remain strong. Similarly for ICICI Bank, I think the reported quarter had some pain points in terms of reported numbers and recognition in terms of certain elements on the balance sheet. But a large part of that has got recognized, and therefore I think as growth comes back very, very strongly, ICICI Bank is making a very good base. Certain pharma stocks are holding up very well. We are out and done with Trump tariffs. 10 to 15% becomes a base case as we speak. And therefore, certain pharma companies where levers in terms of product pipeline, launches in terms of their branded products, pricing staying in their favor, and expectations in terms of stronger return metrics should stand out. So mid-cap pharma company like a Life remains on our watch list. Strides Pharma remains on our watch list. Very strong play respectively in terms of the CDRMO space. For Strides, I think the US business and ex-US doing extremely well. High growth and EBITDA margin businesses where cash flows remain extremely strong. The third is selective consumer discretionary. And in our opinion, again, I think consumer stocks over a longer period of time structurally should start continue doing well. CCL products as an example remains on our watch list and part of our swing portfolios as well, where our belief is that the kind of improvement that they've probably done in terms of their product mix, expanded capacity, specifically when it comes to their Vietnam operations, the freeze-dried coffee packs at attractive prices, the retail brand doing well, expectations in terms of green coffee prices expected to remain stable, which means margins and free cash flow should remain strong. Last but not the least, I think selective domestic infra and manufacturing themes should continue doing well because the government push and capex has been pretty strong, and therefore these companies are largely insulated in terms of what is happening across the globe. With strong inflows happening in terms of domestic orders with better margins, revenue visibility, and expectations in terms of earnings delivery over the next few quarters, selective infra and manufacturing, domestically bound and domestically oriented, should continue doing well. So I think a few sectors which are throwing up where the price earnings growth looks very good.
Okay. Mayuresh, there is a view in the market that the commodity super cycle that saw gold and silver surge 250% over the last 3 years or so moved into energy, and from energy is headed towards the agri space. Sugar is something that we've tracked for a very long while. Stocks, sensible large cap companies are trading at single digit low 5-6 PE, Balrampur Chini in particular. There is this view that the agri space is the next hold for the commodities super cycle. How do you see the sugar space at this point of time?
So, Shelter, if you probably look at the sugar inventory, around 6 to 7 million tons carried forward from the last sugar season, expectations of a 30 million, 31 million ton output. The demand is close to 24, 25. And therefore, I think the tendering which is expected to happen specifically in terms of the ethanol diversion at 20%, which is expected, I think the distillery operations and specifically the B and the C parts in terms of distillery realizations as well, I think that will add value addition to a lot of sugar companies as we speak. The second element in terms of how global sugar production is expected to play out, Brazil remains a key player, and the central region of Brazil is expected to have a stable output as we speak. But again, a large part of their diversion is expected to go towards ethanol, and therefore I think global sugar supply will be very, very tight in terms of sugar demand globally, and therefore sugar prices in terms of realizations on the London bourse in terms of cents per pound should be relatively higher in the next year. Last but not the least, in the Indian context, UP Maharashtra becomes the two most important sugar producing states as we speak. And with a lot of elections happening, and specifically UP going to polls over the next 2 years, the fair remuneration prices, the FRP prices as it is called, decided by the center, and the state advice prices, the SAP prices decided by the states, might actually be ending higher over the next few quarters. And therefore, a combination of all these factors put together make us believe that there is expectation and hope that earnings should show some element of cyclical improvement as we speak. Obviously, I think the entire cycle is dependent on a lot of ifs and buts, as I said, in terms of pricing, in terms of diversion, in terms of the actual tenders being converted to orders. And therefore, I think one must monitor the situation. But all these are enablers for the sector as a whole in terms of positive price action going forward.
Right. On that note, Mayuresh, thank you for joining us. We'll call it day here, but I hope to meet you in person very soon. And here's wishing you all the best in terms of quality research coming out on William O'Neill.
Thank you so much, sir. We'll definitely catch up.
That, ladies and gentlemen, was Mr. Mayuresh Joshi discussing the broader macro of the market. Please stay glued. Lots happening on Business Today Television.